All right, so here we are. We're going to study the study notes for the life portion of the class. So if you have your book, it's on page 68. And the first couple of pages deal with general insurance. So for example, why does the applicant have to sign the application? The applicant must sign the application to certify the statements are true to the best of their knowledge and belief. Now, remember with unilateral contract, only one side makes the enforceable promise. You exchange an act for a promise. You buy your policy, they promise to pay your claim. Now, the primary source of underwriting information is a completed application. What's the only thing the underwriter knows at the home office? What's on the app? Participating policies pay dividends. Non-participating policies don't pay dividends. Now, normally, mutual companies are participating, and stock companies are non-participating, although there are a few participating stock, but you're never going to see a non-par mutual. They must share divisible surplus with their participating policy owners. Now, there are four elements to a contract. They are offer and acceptance, sometimes called agreement, competent parties, consideration, the values exchanged, and it's got to be a legal contract, legal purpose. Now, guess what's not here? Signatures. You don't have to have signatures to have a legal contract. Also, commissions and settlement provisions are not part of a contract. So you may see those as distractors. Life policies include MIE, mortality, interest, and expenses. Health policies include morbidity, interest, and expenses, the chance of getting sick. Now, if you want to make a change in the contract, what happens? Any change in the policy application must be initialed by the applicant. Now, if I say non-med, what does that mean? Non-medical application means physical exam is not required. Now, if I said guaranteed issue, that means you're going to get a policy. I don't know what you're going to get, but you're going to get something. Non-med says we're going to ask a bunch of health questions. If we don't like the answers, you still may not get it. Now, the insuring clause is the how you're insured and includes the promise to pay benefits by the insurer. The promise is the insurer's consideration. We will pay if this happens. Now, if you buy your policy, the insurer is prevented from adding any external documents because of the entire contract provision. See, they can't change the contract without your written permission. Another way of looking at insuring clause is it has the covered causes of loss or the perils. Is it accident only? Is it accident and sickness? Another way to look at consideration is the premium and statements by the insured. So remember, the consideration part of the applicant would be the premium and statements by the proposed insured. Now, what if the insurer accepts an incomplete application? They have to go with whatever they have. Full benefits must be provided. That's the good old waiver and estoppel. The company incorporated in the United States, but outside of North Carolina would be foreign, like Florida would be foreign. Now, if you want to be an insurance agent, you do not have to post a bond, but brokers do. Brokers have to post a bond with the state if they want to be a licensed broker. A person cannot hold himself out to be a financial planner unless that is the case, unless they really are a financial planner, because they have that certified financial planner designation. So agents do not have to disclose compensation, but financial planners do. So a financial planner has an agreement. It says for $500, I'll tell you whether you need insurance or not. The agent doesn't have to tell them how much money they make. Now, what about the guarantee association? Well, you can use the existence of the guarantee association to influence a buying decision. It's supposed to be kind of like a secret. Now, the notice of insurance information practices must be given at the time of collection if the insurer will use non-public sources, like medical records, doctor reports, and even a credit report check. Not just anybody can get that. Medical records, doctor reports, and a credit check. Now, unfair trade practices does not include getting a credit check. They can do that. So there's probably some other unfair trade practices like denying a claim arbitrarily or making you sue them 3 or 4 times for the same information. But just getting a credit check is not considered unfair trade practice. I always thought rebating was a good thing. Well, rebating is now a bad thing. If you discount premiums, pay a finder's fee for referrals. Now, a lot of times they say, if they buy, I'll give you a percentage. That's illegal. That's rebating. You used to have to keep records for 3 years. Generally, records now have to be kept for 5 years. What if an agent signs a blank application? An agent who signs a blank application is guilty of a misdemeanor. When in doubt, pick misdemeanor. There are very few things that are serious enough to be felonies. Now, what if you are going to the office and the agent discovers a premium check that's made out to the agent? What do you do now? Turn it in anyway and wait for an amendment? Go and cash it? Get a money order? No, you have to turn right around, go back, and get a new check. You're only going to let that happen once, right? A third-party insurance policy means you have insurance on somebody else. It can include the applicant. In this case, you're the owner, the insurer, insurance company, and the insured, but not the beneficiary. The beneficiary is not a contract party. Now, there's a thing about change of policy. If a policy is changed, the agent must obtain the signature, signed acceptance from the policy owner. So see, they can't put the war clause in your policy without your permission. If you want to switch from fixed loan interest rate to variable loan interest rate, they can only do that if you sign and agree to do that. Offer and acceptance is the same as agreement. Now, what if an agent sells a policy from an unauthorized or non-admitted insurer? An agent can be personally responsible for 100% of the claim while representing an unauthorized, non-admitted insurer. Now, replacement laws are designed to do what? Protect the public interest. They want to protect the public. But they certainly do not set minimum replacement rates. You must replace a certain number of policies. That would be pretty stupid, wouldn't it? That's probably a stupid distractor somewhere. All right, defamation. Defamation includes malicious or derogatory statements about the financial status of another company or an agent. Don't buy from them, they stink. That would be defamation. Okay, agent appointments are effective if both the agent is licensed and the insurer is authorized to do business in that state. So if you remember, we were talking about how we had a guy that worked for our company that had a property casualty license, and then the company decided to stop selling those policies. So he had to go find another place to work for. Both the agent and the company must be properly licensed and appointed. Now, officially, to get your license, you have to complete 20 hours of classroom study or an approved correspondence course. Now we have the interest adjusted net cost index, how you compare insurance policies. So you may see this insurance cost indexes or indices are only valid when consumers compare similar policies. You have to compare similar policies. Again, replacement laws are designed to do what? Protect the public, prevent misrepresentation, protect the consumer. Don't be surprised if you see this 3 or 4 times on your test. Now, what if you have a group plan and they're taking money out of your check and sending it in? And they stop doing that. They don't send it in. And then you don't have insurance. You're pretty upset. If the group insurance administrator wishes to discontinue a group policy, the members must receive 45 days notice in advance. Now, many people will see this question on the state exam and they would think, oh, it's 10 days, or it's 30 days, or it's 20 days. No, it's 45 days. They used to put this only on the health test. You may see this on the life test as well now. Now, remember again, in North Carolina, you don't have to renew your agent license. The license is continuous, but the appointment is only good for 1 year at a time. So the insurance company has to renew your appointment. All right. Now, here are some notes, and we talked about some of these earlier in the week about life insurance. An employer must have 10 employees to qualify for a group life plan. Now, health, you can have as few as 2. There's no such thing as group key person. You're probably only going to have 1 or 2 key people. A corporation has insurable interest in a key employee, but not an aunt or their favorite niece. Not 2 coworkers who plan to go to business when they retire 3 years from now. An IRA is a qualified retirement plan. A third-party contract requires ownership on a different person. So you would buy insurance on your 7-year-old kid. That's a third-party contract. Now, a sole proprietor is just one person. So a sole proprietor owning a policy on themselves is not considered a third-party contract. Again, that must be some kind of crazy distractor. But no, a sole proprietor buying a policy on himself would not be a third-party contract. Now, the corporation owns a policy on a key employee. They own it. They pay it. They decide how much it's for. But they cannot change the cash value interest rate, because the cash value loan interest rate is non-negotiable. It's a contract of adhesion. And you don't get to pick your loan interest rate. The insurance company tells you what it is. Now, most of the time it's fixed rate. If it's a variable rate, they can vary it on you and there's nothing you can say about that. Now, family policy includes term insurance on the spouse to age 65. So if the spouse dies at 66, the benefit is 0. Many people see this on their test. Now, variable universal life consists of what? An investment plus term coverage. All right, we talked about. Now, we talked about this one earlier in the week too. G has a $25,000 whole life policy with an annual premium of $500. After 10 years, G dies and the beneficiary gets $30,000. What type of rider does this policy have? Return of premium. Return of premium. Now, universal life has three components: mortality, expenses, and interest. I guess I should say mortality, interest, and expenses. The cash value varies with the performance of these three factors. Now, it grows at the current rate, not the guaranteed rate, like interest-sensitive policies. So whatever the current rate is, that's what you're going to get. Now, universal life has a month anniversary. So every month, the mortality, cost of insurance, is deducted from the cash value. Interest is credited to the cash value. Facility of payment comes from the Latin words facile, meaning easy. We want to make it easy to get money out of the policy. So facility of payment is certainly not a premium paying method, whatever that means. Now, what do endowments and term policies have in common? They both have a specified beginning and ending date, and would pay if the insured dies within that policy period. Now, the term policy most likely to be renewed would be 10-year renewable term. There's probably 2 or 3 distractors, and that's the answer there. 10-year renewable term would be renewed for another 10 years. Okay, what's an endowment? An endowment consists of insurance and rapid cash accumulation. So you're paying more in, it's going to endow sooner. So if you think about it, what did we say? Half a loaf is better than no loaf at all. Maybe they really want to buy all whole life, but they just can't afford to do it. So instead of buying nothing, we could get a term rider. The primary purpose of a term rider is simply to increase the amount of insurance available. So you could have a term rider and you could double your coverage or triple your coverage by adding that rider. Universal life combines term life insurance and an interest accumulation account. Now, what about this thing about aviation? Aviation. Now, if you are a passenger on an airplane, then you're covered, no problem. But if you have a private plane or do ultralight flying, then there may be aviation restriction for these hazardous activities. Now, they may offer you the aviation rider, and if you don't take it, now you're not going to get covered. But the full face amount of a policy is paid due to aviation-related causes as long as there is no aviation restriction. So if Denzel bought his policy at 19, there wouldn't be an aviation restriction. He could take flying lessons at 29, they would now pay because there was no restriction when he bought his policy. Remember, past, present, not the future. Now, one way to have 100,000 insurance on a husband and 25,000 on a wife, you could buy a whole life on the husband and you could add the other insured rider on the wife. You might see other covered insured, other insured rider, just add somebody else to the policy. Now, there's another kind of a crazy term called impairment rider. The impairment rider says if you've got a bad back, they may not sell you, they may exclude that on your disability policy. But that only applies to health insurance. They can't say with life insurance, if you have a pre-existing condition, they can charge a higher premium, but they can't put on an impairment rider. Anything to do with your heart, we ain't gonna pay. They either do or they don't. Now, contestability. The insurer cannot contest the validity of a life insurance contract after 2 years. After 2 years, a lie becomes the truth. You got them, they got you, because of the incontestability clause. The change of policy provision allows the insurer to switch to a higher premium policy without underwriting, since the risk of the insurance company goes down. So you can always switch from term to whole life because they're getting more money, but they won't let you switch from whole life back to term unless you prove that you're insurable, because their risk just went up. They're not getting as much premium from you. L has a whole life policy. He's paid $16,000 in premiums and cashes it in, getting $19,000. Ooh, how much would be taxable income? $3,000. Everything over his cost basis. Now, a life insurance policy might have a whole bunch of things. We would not have a guaranteed dividend scale. Because why? Because dividends can never be guaranteed. How do we classify annuities? Immediate, deferred, single, flexible. Annuities cannot be classified by face amount. That would be kind of silly. Now, with a life and 10-year certain annuity, if the annuitant dies after 8 years, then what? 2 more years would still be paid. Now, suppose a policy owner stops paying premiums. And the insurer switches it to extended term. Then, if the insurer dies within that term, how much is going to be paid? The whole thing. Full face amount is payable. See, extended term is the same amount of insurance. Now, with a straight life annuity, payments stop at the death of the annuitant. So that's a bigger size monthly check, but when you die, that's it. How could you protect a policy from lapsing? Well, there's 3 ways to do that. You could do waiver premium. So if you get disabled, they'll make the payments for you. You could do APL, automatic premium loan. And they'll do that automatically as long as you check the box. And then don't forget, we got a 31-day grace period. And if you die within the grace period, then it's still going to pay it. So that's pretty clever. All right, so T had a term policy renewal premium due on April 1st, but died on May 14th. Oops. What are they going to pay? Denied, because the grace period has expired. All right, T has a $10,000 term policy. Renewal premium due on April the 1st, but died on April the 23rd. Now what? The claim will be paid at $9,800 because the unpaid premium will be deducted from the payment. If a life insurance policy elapses, the insurer must allow the application for reinstatement up to 5 years after lapse. However, only if it lapsed for non-payment. Because remember, you can't unsurrender. You can't unsurrender. To reinstate a policy, evidence of insurability, repayment of back premiums, and even some interest are required. All things being equal, a reinstated policy, will it be more, less, or same as just buying a new policy? It'll have a lower original age premium. So one of the reasons you want to get your policy reinstated is you got that 23-year-old rate instead of the 35-year-old rate. If a person commits suicide in the first 2 years of the policy, the claim will be denied, but the premiums will be refunded to the owner, and they're going to get some interest. Plus interest. But after 2 full years, suicide is paid. With the results type war clause, if a person dies from non-military related cause, full death benefit is paid. So in other words, if a soldier goes home on leave and plows into a tree, gets into a car accident, they're going to pay that because it's not military related. Waiver of premium. This provision pays premiums while the insured is disabled. And when the insured recovers, payments will have to resume, but back premiums are not required. That wouldn't be much of a waiver, would it? So you just pick it up from there. The guaranteed insurability provision provides for the purchase of additional coverage without evidence of insurability. And it comes around every 3 years. However, when you do the additional coverage, you must pay attained age, not original age rate. Oh, here's something. The mode of premium payment can be changed only by the policy owner. You know, sometimes credit cards will send you a letter and say, oh, well, we just want to let you know that you have been paying your credit card on the 20th, but starting next month, it's going to be due on the 8th. And then you end up being late because you didn't know they switched it on you, right? Well, this could never happen with a life insurance policy. They can't change the premium mode monthly, quarterly, annually. Only the policy owner can change the premium payment mode. A revocable beneficiary has no control over the policy. An irrevocable beneficiary, on the other hand, has a vested interest in the policy. So remember, if Jackie is irrevocable, then Kenny can't make any change in the policy without her permission. Now, if she does give permission, though, you can change it all day long, as long as she gives permission. Remember the one about how you wanted to borrow money at the bank, but it was an irrevocable beneficiary? So just get their permission, and then you can do the collateral assignment to the bank. All right, here's one that everybody's been seeing and nobody's been knowing what to do. Prearranged funeral policies. What is that really? You just buy a life insurance policy in an amount to pay for your funeral. They have specific disclosure requirements, but the funeral home does not have to disclose the cost to the funeral home of the policy, the profit they made off the policy, and the commission paid to the agent. Now, they do have to tell you the cost of the casket, the transportation, digging the hole and filling in the hole, but they don't got to tell you how much money they made. Now, what policy best describes one where the cash value fluctuates to reflect changing assumptions about mortality, interest, and expenses? Why, I guess it'd be Universal Life, MIE. They mess with mortality, interest, and expenses. You know, cost of insurance is also known as the mortality charge. What policy might have an adjustable premium? Universal Life. Now that could be tricky. Adjustable life combines whole life and term, and I suppose you could adjust your policy. But with Universal Life, there is no set premium. You can make it whatever you want. Only Universal Life has a target premium. Hit what you're aiming for in life with target life, target premium. That way it won't lapse. What does the Universal Life expense charge really do? It covers administrative charges like the administrative charge of your checking account at the bank. Now, variable life policies have the reserves in a separate account invested in stock and bond mutual funds. So that's where they put the money, stock and bond mutual funds. With a family policy, if the insured breadwinner dies, what happens? Does the policy blow up? The coverage on the other family members stays in effect. Stays in effect. All right, next page. Short-term, and this is the last page, by the way. Short-term survivorship. Now, in the old days, they call this the common disaster provision. You might still see this sometimes. The short-term survivorship or common disaster provision is designed to avoid paying the proceeds to the beneficiary's estate if the beneficiary dies within a certain time period after the death of the insured. So remember the thing about when the roll is called up yonder, the roll is called down here. Well, why be in such a big rush to call the roll? Short-term survivorship, common disaster, you can wait maybe 14 days, 31 days, maybe even 90 days before calling the roll. That way we don't have to pay the money to the state. We can just give it to the next beneficiary in line. If M dies after the end of the term policy grace period, what happens? No benefits are paid because the grace period's over. And there's no cash value to keep it going either. When it's over, it's over. The contingent beneficiary, secondary contingent beneficiary, receives the death benefits, proceeds, when the primary beneficiary predeceases the insured. So maybe that would be tertiary, right? Well, no, we got secondary, right? Primary, secondary, then tertiary, first, second, third. So the contingent beneficiary receives the death proceeds when the primary beneficiary predeceases the insured. And of course, the insured has to be dead. They predecease the contingent beneficiary too. So Kenny dies, Jackie dies, Christine's going to get the money, contingent beneficiary. Now, if you do have premiums paid under the automatic premium loan, APL, and then the person dies like a month later or 3 months later, the death benefit will be reduced because you had to take some of the cash value to pay the premium. Then instead of paying 100,000, they might only pay 99.2. So if you do the APL, it will reduce the amount of death benefit available. All right, who gets the proceeds from the life policy? The lawful beneficiary. I don't know why they say that, but you may see the lawful beneficiary, the legal beneficiary, the proper beneficiary. Now with the endorsement method, a policy must be changed at the home office of the insurer. since the change is recorded right on the actual policy. So you have to send it to the home office and they have to change it up there. Automatic premium loan lowers the face amount because the cash value is used to pay the premiums, but it does ensure the policy won't lapse. I guess there's two versions of that question. To sell a variable life or variable annuity policies, an agent must have both an agent license from the state and a securities license from NASD or FINRA, because they changed the name. Now, what if they don't want to pay your claim right away? They want to investigate. Fine. Life insurance interest on claim proceeds is 30 days. If it takes more than 30 days to pay up, they must add interest. Now, if you have group life, and you leave the business, you have the right to convert within 31 days of leaving. And remember, no underwriting. But you go from group term to whole life. So your premium is going to be way more expensive. Now, what's the only thing that can provide a guaranteed monthly income? Why, an annuity can give you a guaranteed monthly income. Now, an immediate annuity pays out immediately or at the end of the first month. Now, we know they could put it off a little while, but you're not supposed to know that. So, okay, give them money this month. The next check, starts coming out next month. Well, what type of annuity would have delayed withdrawals? Well, that would be a deferred annuity, because the deferred annuity pays out later. Deferred annuity pays out later. Now, with a joint life annuity, benefits stop at the death of the first one. What a stupid idea. Joint life annuity, if either one dies, it's over. But the type of annuity that pays full benefits to both annuitants, even after the death of the first one, is joint and survivor. You might see joint and survivor 100%. The exact same benefit to each one. Now, straight life, pure life, single life annuity pays only for the life of that annuitant. And so if it's just you and you don't care, you're Bing Crosby, you could do a single life, straight life, pure life. It only pays as long as you're alive. Okay, now the non-forfeiture option. Remember, we got cash surrender, reduced paid up, extended term. Which gives you the most death benefit? Why, it's extended term, because extended term is the same amount. Who declares policy dividends? It's the insurance company board of directors. So whether it's a stock company or it's a mutual company, the board of directors decides whether or not to pay dividends. Now, what about this? I have a dividend option that creates separate policies. Why, that's John's favorite dividend option, paid up additions, your little teeny tiny paid up policies. Now, they're stacked on top of each other. And deep in the computers of the insurance company, they all have a cash value. Cash value grows, death benefit grows. But if you think about it, paid up additions does give you little teeny tiny policies. They're all paid up. Now, this one is a little bit tricky. A bank CD can be withdrawn and placed with an insurance company as an annuity contract. but you can't use a CD to buy life insurance. Let me get this behavior. Since life insurance cannot be used to fund an IRA. So you can do an IRA annuity with your CD, but not life insurance. Now you can take CD funds. It can be used to purchase a deferred annuity from an insurance company to save up for retirement. So see, that's what happened. That's why banks started to get into the insurance business, because if you got money in a CD, you got to pay taxes each year as it grows, even if you don't really need the money. And so people were taking money out of their CDs and buying deferred annuities from an insurance company, because the deferred annuity has tax deferred interest. You don't pay interest while it's growing. And you could use that to save up for retirement. Only nonprofit organizations can purchase a tax sheltered annuity. So a car dealer is not eligible for a TSA. The income received from a TSA is not tax-free. It's taxable income, just like income from an IRA. So we just covered this recently here, where we said that TSA really is a salary deduction IRA. If you stop paying on a life insurance policy, you've got your non-forfeiture options, right? Reduced, paid up, extended term. But if somebody stops paying into an annuity before maturity, then the contract owner can get the surrender value. You can cash in your CD, or cash in your annuity early. You don't get those other options like extended term, reduced, paid up. You would simply get the surrender value on an annuity. All right, now the automatic non-forfeiture option that it provides continuing accrual of cash value is, now this is a typo. It's not extended term. It's reduced, paid up. I was watching a TV show where a guy had some recipes, and people were trying to use his recipe book to create a recipe, and it just didn't work. And they called him up and he said, "Oh yeah, I made some mistakes on purpose, so that way if somebody steals my recipe book, they can't duplicate what I've done. So if they steal my book, they're going to miss this one." So continuing accrual of cash value is not extended term, but reduced, paid up. But now if you die within the extended term policy, they pay the full policy face amount. That'll go to the beneficiary. So extended term pays the full face amount. Reduced, paid up provides for continuing accrual of cash value. All right, so a lot of people have reported seeing questions about these topics on their state exam. And I thought it'd be good to just kind of go through this and make a little bit more sense.
Appreciate it.